Imagine two different situations where two people are getting ready to invest in two very different fields in order to achieve financial freedom. Both of these people work very hard to save money to invest. They both want to secure their financial future, but they take two completely different paths. A few years later, one is enjoying financial freedom, while the other is still struggling with daily problems. So, what made all the difference? If you're new to the channel, like, share, and subscribe to get more uplifting content. The first investor decides to invest in the transportation business. He buys several buses and minibuses. At first, everything looks promising. The vehicles run every day, the income comes in regularly, but soon, difficulties start to appear. A bus breaks down, the engine has to be replaced, a gearbox is broken, the tires need to be changed, insurance costs go up, taxes pile up, and fuel prices skyrocket. Some drivers don't handle the income properly. Others use the vehicles for personal reasons. Accidents cause the vehicles to be out of service. Every week brings a new expense. The owner spends more time solving problems than growing his business, and meanwhile, his vehicles are getting older. They gradually lose value. Every year, their resale price goes down. His assets depreciate. His stress increases. Second investor? Stocks in the stock market. The second investor makes a completely different choice. Instead of buying vehicles, he becomes a co-owner of the world's largest companies. He invests in solid companies, businesses that sell their products in multiple countries, innovative companies, companies that make billions of dollars in profits. Every quarter, these companies publish their financial results. Some pay out dividends, others reinvest their profits to keep growing. While the first investor is looking for mechanics, the second one simply watches his portfolio grow. He doesn't need to manage employees, doesn't need to fix engines, doesn't need to buy spare parts, doesn't need to keep an eye on daily revenue. His investment works for him even while he sleeps. The comparison. Now let's compare the two situations. The vehicle owner has physical assets, but these assets lose value over time. They require constant spending. They demand daily attention. They create stress. They generate unexpected problems. On the other hand, the stock market investor owns a share of companies that historically can grow over the long term. Even though markets also go through downturns, the more companies grow, the more the potential value of his investments increases. Time becomes his best ally. Compound interest starts to work its magic. Dividends can be reinvested. His wealth can keep growing year after year. The conclusion. This doesn't mean that transportation is a bad sector. It can be profitable when it's very well managed. And investing in the stock market also involves risks. The value of stocks can go up or down, especially in the short term. But when an investor adopts a disciplined, diversified, and long-term strategy with solid companies, they often benefit from a model that requires less daily management and can offer strong wealth-building potential. So the real question isn't just how much are you earning today? The real question is your money working for you, or are you constantly working for your money? The most successful investors aren't just looking to create income. Above all, they aim to build assets that increase in value over time. Because in the long run, financial freedom often belongs to those who own the best assets, not just to those who work the hardest. Thank you for your attention.